You know, every single second of every day, there's this silent global auction happening all around us. We're talking billions of tiny pieces of the world's biggest companies, all being bought and sold in a flash. That's the stock market. And it's honestly one of the most powerful forces shaping our entire world. But how does it all actually work? I mean, really, how does this invisible digital web connect giant corporations with people like you and me and match a buyer with a seller in like an instant? Well, in this explainer, we're going to pull back that curtain. So, our first stop on this tour is the most fundamental question of all. What exactly is the stock market? Okay, so at its very core, the stock market is just the system where people buy and sell shares. And a share, it's exactly what it sounds like. It's just a tiny, tiny slice of ownership in a public company. Probably the best way to picture it is to think of a massive global marketplace. But instead of stalls selling spices or clothes, they're trading little pieces of ownership in the world's biggest businesses. Now, what's really crucial to understand is that this marketplace isn't one single building somewhere. Nope. It's a huge digital network that connects all the major stock exchanges, countless online trading platforms, and literally millions of investors all over the globe. And this global marketplace, it's actually split into two very different sections. A good analogy is a car dealership. You've got the showroom for brand new models, fresh from the factory, and then you've got the lot out back for trading in used cars. And we call those two parts the primary market and the secondary market. So the primary market is where shares are born. This is when a company has an initial public offering. You've probably heard it called an IPO. They're selling brand new shares for the very first time, and the money from that sale, it goes right to the company to help it grow. But once those shares are out in the world, they get traded on the secondary market. This is where all the daily action happens, investors buying from and selling to each other. And here's the key difference. The company doesn't see a dime from these trades. Okay, so if the secondary market is where most of the trading is happening, how does a single trade actually get made, right? How does a buyer find a seller? Well, at its heart, it's a pretty simple matchmaking process. See, a buyer places an order saying, I want to buy shares at this price. And a seller places an order saying, hey, I want to sell those same shares. The market's super powerful computer systems then act like a high-speed dating service, instantly scanning for a match. The second it finds a buyer and seller whose prices agree, bam, a trade is made. And this constant matchmaking, happening millions of times a second, is the engine that drives stock prices. It all boils down to the simple law of supply and demand. Think about it. If a company announces some amazing new product, suddenly everybody wants to buy its stock. That's high demand, and the price is probably going to go up. But if they report bad news, everyone might rush to sell. That's high supply, and the price will likely go down. It's the simple push and pull that makes the market move every single day. Okay, so that's the mechanics. But let's zoom out for a second. Why should we even care about this giant digital marketplace? Why does it matter so much to the rest of the economy? Well, the market really plays three huge roles. For companies, it's how they raise money, capital, to fund new ideas and growth. For investors, it's a chance to actually own a piece of those companies. And for the entire system, it provides something called liquidity, which is just a fancy word for making it really, really easy to turn your shares back into cash. And this liquidity is absolutely essential. Without a stock market, trying to buy or sell ownership in a company would be so slow and so difficult. I mean, can you imagine having to find a buyer yourself, haggle over a price, and then do all the paperwork? The market just solves that whole problem, making trading fast and efficient for everyone. All right, we have covered a lot. So let's boil this entire thing down to the three most essential actions that really define what the stock market is and what it does. First, it's a funding engine. Companies use the market to get the money they need to build things, to innovate, and to expand their business. Second, it's an ownership platform. Investors use that exact same market to buy a slice of those companies, giving them a chance to share in their future success. And third, all of this activity, this constant meeting of buyers and sellers from all over the world, is what makes prices go up and down. The market is never still. It's a living, breathing system powered by millions of human decisions. So now we get the how, the basic mechanics of how a trade happens. But that really leads to the ultimate question in all of investing: why? We know supply and demand move prices, sure. But what moves supply and demand? What are all the forces, from company profits to global news to just plain old human emotion? that can make or break a fortune? Well, that's what we're going to dive into next time.